Everyone watched the Bitcoin Treasury company boom of 2025. Companies buying Bitcoin on their balance sheet, stocks trading at a premium to the Bitcoin they held, share prices climbing without the business doing a simple thing operationally. It was seductive, and for a while, it worked beautifully. But here's what fewer people are talking about. By early 2026, it was quietly unwinding, and the numbers behind that unwind are sobering. This video is about what went wrong, why the model was structurally flawed from the start, and why DigiByte, a blockchain that has been building since 2014, may have already engineered the fix. To understand the trap, you first need to understand the playbook because it was genuinely clever. The first step, a public company buys Bitcoin and puts it on its balance sheet. The second step, the stock starts trading at a premium to the value of the Bitcoin it holds. The market is saying, we believe in this strategy, we will pay a little extra for it. Step 3, the company issues new shares at that premium, expensive paper sold to the market. Step 4, it uses that cash to buy more Bitcoin. And here's the magic part, because new shares were sold at a premium to NEV, the amount of Bitcoin per share actually increases without the business growing at all, without any revenue, without any product. Analysts called it accretive dilution. But step 5 is where it all breaks. The moment that premium evaporates, the moment shares trade at or below the value of the Bitcoin the company holds, every new shares issued to buy more Bitcoin is less efficient than just buying Bitcoin directly. The engine reverses, and it can reverse fast. Let's talk about what actually happened because this isn't speculation, this is data. 37 of the top 100 Bitcoin treasury companies were trading at discounts to their own net asset value by early January 2026. That's nearly 40% of them worth less than the Bitcoin sitting on their books. And the asset itself didn't help. Bitcoin corrected from roughly $126,000 in October 2025 down to around 89,000 to 90,000 by January 2026, a drop of nearly 30% in under 3 months. Now, layer that on top of a financial model built on leverage on a volatile asset funded by a stock premium that can disappear overnight. Even the largest players felt the pressure. Strategy, formerly MicroStrategy and MetaPlanet, both saw their market caps fall below the value of their Bitcoin holdings. Premium that took months to build collapsed in weeks. Macro analyst Alex Kruger called the model, and I am quoting here, an abomination. He compared it to Grayscale Bitcoin Trust episode. That is not fringe view. That is where informed market commentary landed. So what was actually broken? Because I want to be precise here, this isn't just crypto went down. The structure itself had three overlapping flaws. Flaw 1, the reserve asset itself is volatile. BTC dropped 30% in 3 months. You cannot build a stable financial structure on an unstable foundation without engineering something to absorb the shock. Flaw 2, the financial model amplified the volatility instead of dampening it. Leverage on top of volatility, funded by a premium that can evaporate. When it does, equity raises goes from value creating to value destroying overnight. Flaw 3, accretive dilution only works when a premium exists. Once you trade at or below NAV, issuing new shares to buy Bitcoin is less efficient than just buying Bitcoin directly. The whole logic of the model collapses. And the result? A liquidation cascade waiting to happen. Shareholders diluted. Bitcoin sold under pressure to raise cash. Stock price drops further. The flywheel spins backward just as quickly as it spun forward. Now, here's where the trap really tightens. A Bitcoin treasury company that needs working capital, let's say to fund operations or pay down debt, historically faced two choices. Option A, sell the Bitcoin. That triggers a taxable event. It signals to the market that you are exiting the thesis. It puts direct selling pressure on the asset and you permanently lose the upside on whatever you sold. Option B, issue equity. Dilute your shareholders, but remember, once you are trading at or below NAV, issuing new shares to buy Bitcoin is actually destroying value, not creating it. The option that was supposed to be clever becomes lethal. Two options, both painful, both structurally corrosive under the conditions we described. There was no third option until DigiDollar. DigiByte is a UTXO blockchain, the same fundamental architecture as Bitcoin, that has been running since January 2014. No ICO, no venture capital, no central company, over a decade of community-built infrastructure. And out of that infrastructure comes DigiDollar, a fully decentralized USD-pegged stablecoin native to the DigiByte chain. DigiByte's own framing of the core idea is what quoting directly: liquidity does not have to mean liquidation. Let me explain the mechanics because they matter. Step 1. You log DGB as collateral. It goes into a time-locked UTXO output, the same type of structure Bitcoin uses. Lock periods run from 30 days up to 10 years. Collateral ratios between 200% and 500% over collateralization. The keys stay with you, no third party holds your asset. Step 2. The protocol means DigiDollars pegged one-to-one to the US dollar. The price is maintained by a decentralized Oracle network pulling real-time DGB to USD rates from multiple exchanges. No centralized issuer, no Tether, no USDC. The chain itself is the bank. Step 3. When you are ready, you burn your DigiDollars. The protocol release your locked DGB. No margin calls, no forced liquidation, no cascade. A sharp price move does not automatically close your position. You decide the timeline, not a margin engine. Now let's map this back to the problem we described, because this is where DigiDollar becomes genuinely interesting as a treasury primitive. A DGB-based treasury that needs working capital has a third option that didn't exist for Bitcoin treasury companies. Mint DigiDollars against locked DGB, access USD liquidity, run operations without selling the reserve, without diluting shareholders, without triggering a taxable event. When a price drop hits, the over-collateralization and the time lock absorbs it. There is no margin call engine forcing positions closed during a lockdown. Compare that to the BTC treasury structure, where a price drop compresses the premium, makes equity raises less deficient, and can trigger forced selling at the worst possible moment. The dynamics are genuinely different at the structural level. Hold the reserve, mean stability against it, separate ownership from liquidity. That is the architecture DigiDollar is proposing. Here's the flywheel that powers this, and notice what it runs on: collateral mechanics, not a stock premium. Every time a user mints DigiDollars, their DGB exits active circulation for the duration of the lock. More positions, more DGB lock, tighter circulation supply. DigiByte has a fixed maximum supply of 21 billion DGB, roughly 1.94 DGB per person on Earth. Scarcity is structural, not manufactured. The architecture has two distinct layers doing two distinct jobs. Log DGB is the scarce savings layer, which is the reserve. Then DigiDollar is the spending layer, which is the stable, liquid, usable form. One chain, two economics functions, cleanly separated. When users redeem, burning DigiDollars to recover their DGB, the cycle continues. The supply tightening is time-gated and user-controlled, not forced by a liquidation machine. The flywheel spins on mechanics, not on market sentiment. Now, and I want to be clear about this because credibility matters. There are real limits to these thesis today. I'm going to state them plainly. DigiDollar is not yet live on mainnet. Minting and redemption are working on testnet. A mainnet launch is targeted for 2026. That means a DGB-based treasury model is right now a thesis. It is not a track record. There is a difference. DGB is itself a volatile asset. Any model resting on DGB inherits that volatility. The argument is not that volatility disappears, it's that over-collateralization and time locks absorb it differently than leverage and equity issuance do. That distinction matters, but the underlying volatility is real. Oracle integrity is an open question. Decentralized price fuels are critical to this model working correctly. Multi-exchange design reduces single point of failure, but real-world stress testing at scale is still at hand. And adoption at scale is unproven. Elegant on paper, the mainnet launch will be the first real test. Watch those metrics, watch the mainnet. This is worth following closely, not blindly. The Bitcoin treasury era proves something real, putting a volatile asset on a balance sheet and financializing it around a stock premium works, right up until the premium dies and the leverage turns against you. DigiDollar proposes something quieter and arguably more durable. Don't financialize the volatility, neutralize the need to sell. Hold the reserve, mean stability against it, no forced liquidation, no dilution spiral, no margin calls amplifying the drawdown. If the BTC Treasury model was the leverage beta trade, the aggressive premium dependent amplifier volatility play, then DigiDollar may be the self-custody treasury primitive that the next era gets built on. DigiByte, building since 2014, the parallel economy is being engineered quietly on chain in the open. The links are in the bottom of this video. Make sure to follow and, as always, do your own research.